The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. If you are a regular, you know who I am. If you're new, I will introduce myself. I'm your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe Associates. I'm going to begin, as I always do, by saying thank you. Thank you for taking time to listen, but above all, thank you for your service to the government, to the country, to me, to everyone. You do not hear that enough, but you're always going to hear it here. The other thing you are always going to hear and see here is my buddy, Ed Zerndorfer. The guru is back with us once again as part of our ongoing mission to reach, teach, and serve you, the career civilian feds. Once again, we follow Ed's Fed Zone articles. You can find them on our website at fed-zone.com. Gives us one more way to reach and teach. So here we are. It's autumn. And our thoughts now are on fall, football, and RMDs? Okay, so Ed, your article says they should be. We should be thinking about RMDs. Is that right?
Well, I'm a little biased here because I turned 73 this year and I have to take my first RMD. So it's a little biased here. So
okay, that's fine. No problem. No problem with bias. As long as we disclose our bias, we are perfectly fine.
Okay.
So we should be thinking about RMDs, and we've had some changes to that with the Secure Act, the Secure 2.0, made some changes to all the RMD rules. So remind our folks what those changes are.
Yes, Dan. The Secure Act was passed in December 2019, and one of the provisions coming out of the Secure Act was the fact it raised what's called the required beginning date. What is the required beginning date? It is the date that one has to take his or her first required minimum distribution, RMD, from what? A traditional IRA. If you are participating in a qualified retirement plan, like the Thrift Savings Plan or a 401k plan, a 403b plan, a simplified employee pension IRA, a simple IRA pension plan. Again, you have to, when you reach that required beginning date, you got to take out your first of lifetime. This is not just a one-time payout. It is a lifetime annual withdrawal that you have to make from the plan. It's a minimum. It's a minimum amount. We'll get into the details here in a few moments. You can take out more, but you got to take out the minimum.
Gotcha.
Now,
and there's different ages based on when you were born, right?
Right. So with the Secure Act passed again in December 2019 did it. Until then, the required beginning date was April 1st following the year that one turned 70 and a half. But then with the passage of the Secure Act 2.0, the rule changed as follows. If one was born before July 1st, 1949, the RMD remained at April 1st following the year that you turned 70 and a half. If you were born after June 30th, 1949, then the required beginning date was April 1st following the year you turned 72.
Gotcha.
Now that was the Secure Act. Then 3 years later, in December 2022, Secure Act 2.0 further changed the RMD as follows. If one was born between July 1st, 1949 and December 31st, 1950, your required beginning date was April 1st, following year you turned 72. If you were born between January 1st, 1951 and December 31st, 1959, the required beginning date was April 1st, following the year you turned 73. And
Gotcha.
finally, anybody born after December 31st, 1959, the required beginning date is April 1st, following the year that you turn 75. And that's what it is.
Okay.
They made no changes. So it went all the way from 70 and a half all the way up to 75, depending on what year you were born.
Gotcha. And so then your article makes it easier for folks and tells everybody who needs to take one this year. So tell us about that.
Okay. So in the article, I pointed out that anybody who was born, anybody born before December 31st, anybody born before January 1st, 1951, has to take an RMD this year, no later than December 31st, 2024, from their traditional IRA. Even if you have retired, let's say you're a federal retiree, you're retired from federal service, and
Sure.
you have a traditional IRA, you have to take an RMD then. Or if you're still in federal service, you're still in federal service, you were born before January 1st, 1951, you still have to take the RMD from the traditional IRA. I'm saying that, Dan, because, like I said a few moments ago, the TSP has its own RMD. But here's the difference. You do not have to take an RMD from a qualified retirement plan like the TSP if you're still working. Once you reach your required beginning date, you do not have to take, for that company, you do not have to take a required minimum distribution as long as you stay working. When do you have to take that first one then? April 1st, following year that you retire. April 1st,
Gotcha.
following you retire. So again, traditional IRAs makes no difference if you are retired or not working for the company. You got to take an RMD. Now, there's one other category of individuals, and this is me. I was born in 1951, so my RMD, my RBD is this year. I have to take my first required minimum distribution from my TSP account no later than April the 1st, and my traditional IRA no later than April the 1st, 2025. I don't have to take it by December 31st because you got that for that first year. They give you an extra 3 months to take your first RBD. But
Gotcha.
Here's the problem: if I decided, well, I think I'll wait till 2025. I'll take my first traditional IRA RMD in February 2025. That'll be for 2024. I have to take another RMD for the year 2025, which is going to be due no later than December 31st, 2025. Keep in mind, Dan, that the RMDs are fully taxable.
Yep.
And it could push you into a higher tax bracket. I have to pay more for Medicare Part B. I can go on and on and on. So that's why I took my first RMD this year early in 2024. So this way I don't have to take two of them. I'll take my next one in 2025, but that'll be due no later than December 31st, 2025.
Gotcha. And you also mentioned there are rules for 2024, basically, that affect the folks who inherited IRAs from others. What do we need to know there?
Oh, Dan, we get so many questions about this. The Secure Act passed in December 2019.
Made it clear as mud.
It just made accountants and financial planners very busy, and I just want to mention what was part of Secure Act 2.0 in addition to raising the required beginning date. If one inherited a traditional IRA from someone before, let's say someone died before January 1st, 2020, and let's say it's mom, and they named mom named her son as the adult son as the beneficiary of her IRA. Mom died, let's say, in July 2019. Well, their son inherited that IRA. He has the option. He has to take the money out. He can't just keep it there. He can't merge it with his own IRA. But he can take the money out over his life expectancy. He can spread out the distribution. He can take an RMD every year for the rest of his life, thereby spreading the tax liability, the overall tax liability. You can spread it over a lifetime, as opposed to having to take it out, let's say, within 10 years or 5 years. You can spread out the tax liability. Well, that changed because effective January 1st, 2021, anybody who inherits a traditional IRA who is not what's called an eligible designated beneficiary, EDB, and that would include an adult child, it would include a grandchild, it would include, let's say, a sibling who is more than 10 years younger than the IRA beneficiary, and the law says that non-eligible designated beneficiary has to withdraw their inherited IRA within 10 years of the death of the IRA owner. They gotta clear it out. They gotta clear it out. They gotta take out all the money within 10 years. 10 years. Now, they can wait till the end of the 10th year. So here's an example. Suppose we have mom died. Let's say mom died in July 2020, and named an adult child, daughter, let's say, as a beneficiary. Well, under Secure Act, the adult child has until December 31st, 2030 to clear out the IRA. They have a 10-year. Now they don't have to take it out each year. They can wait to the end. But here's the problem: if they wait to the end of the 10 years, they have a whole lump sum amount of money, which could push them into a higher tax bracket. That's why they should really consider taking a little bit each year.
Makes sense. Now let's shift gears here, Ed, because your article does, and actually kind of talk about things that could help us in the other direction, meaning not take us to higher tax brackets. And your first one is great, and it's something that a lot of feds might not know a lot about, and that's Qualified Charitable Distributions, QCDs. Tell us about those.
Okay, Qualified Charitable Distributions have been around for a few years, and what a QCD is that if you are an individual and you're over 70, you're 70 and a half or older, you can request, if you have an IRA, that the IRA custodian withdraw the money from your IRA and pay it to a qualified charity, like a church, a synagogue, a mosque, the Goodwill. It's a distribution. And here's the benefit of that. Number one, you're being charitable, okay? You won't get a deduction, though, but also that distribution will not be included in your income. So I say that because most people today do not itemize anyhow. In order to get a deduction when it comes to charitable contributions, you have to itemize. Most people do not itemize. So losing the deduction as a charitable contribution is no big thing, but it's not going to count as income. And in so doing, it cuts down the size of your traditional IRA. If you've reached your required beginning date, the QCD will count as if you have taken enough out, you'll count as your IRA RMD. So if someone has an RMD in a given year, Dan, let's say of, I don't know, $25,000. $25,000, that's for their RMD. They got a huge traditional IRA. Well, they have several charitable organizations. They have 5 charitable organizations they would like to give to. Each is going to get $5,000. So the individual, the IRA owner, says to the IRA custodian, I want you to send $5,000 to each of these charitable organizations. $25,000 total. That counts towards their RMD, not included in income.
Nice.
Not included in income, and you've met your RMD. Remember, the RMD, I said earlier, is taxable. it's going to be included in your
Absolutely.
income, but not in this case.
Absolutely. And Ed, you and I have talked about it. I think especially some of these folks that are going to be at the age 75 before they have to start, I think if they're not paying attention, they could get some real surprises relative to tax bills, and then further downstream, as you mentioned, Medicare Part B premiums jumping up. So folks, the time to think about this is before, not during and not after. So staying with this vein, Ed, you round out with a great section on Roth conversions, and I know that is a favorite topic for you. So tell us a little bit about that.
Yes, we get so many questions all the time, serving those who serve. I'd like to get more money in my Roth IRA. What do I need to do? Well, there are two ways you can get money into your Roth IRA. One way is to contribute to a Roth IRA directly each year. You're allowed to put into a Roth IRA a certain amount of money. Like, for example, 2024, if you're under age 50 this year, you can contribute a maximum of $7,000 to a Roth IRA. If you're 50 or older by the end of this year, $8,000. But here's the problem. If your income is too high, your adjusted gross income, IRS says you're not allowed to contribute to a Roth IRA because your income's too high. So how do you get money in a Roth IRA? Well, here's the next possibility. If you're still in federal service, you can contribute to the Roth TSP. There's no income limitations for contributing to the Roth TSP. And then somewhere down the line, you can do a direct rollover of your Roth TSP into a Roth IRA. That's always allowed. Why are Roth IRAs so good? There's a lot of reasons. Number one is that the money coming out is from Roth IRAs tax-free. Also, Roth IRAs do not have required minimum distribution rules. That money can stay in there indefinitely as long as you're living. And you name a beneficiary, you pass away, let's say a non-spouse, the beneficiary will inherit the Roth IRA. Will they have to take the money out? Yeah, but tax-free. Tax-free.
Yeah.
We're talking about a generation of, wealth transfer here. There are people have huge Roth IRAs. They're going to turn it over to the next generation. That's better than life insurance. Life insurance is tax-free. So that's the second possibility. The third possibility is that, actually there's four. When it comes to the traditional TSP, one is allowed, when they retire, or if they're still in federal service at age 59 and a half, to transfer a portion of their traditional TSP to a traditional IRA.
Gotcha.
And then convert the traditional IRA to a Roth IRA. One cannot, I repeat, cannot request a transfer of the traditional TSP to a Roth IRA. That's not allowed. IRS does not permit that because you're going from apples to oranges here. The traditional TSP is all pre-tax dollars. The Roth IRA is after-tax dollars. You can't go from pre-tax to tax. You have to go to somewhere in between. And that in between will be your traditional, request a direct rollover of the traditional TSP to a traditional IRA, and then convert the traditional IRA to a Roth IRA. And the fourth way is if you have an existing traditional IRA, convert the traditional IRA to a Roth IRA. So those are the four ways.
Sure.
Conversion is not for everybody, Dan. It's not for everybody. And anybody who's thinking about doing this definitely has to work with a qualified advisor, financial advisor, an accountant. There's certain rules. I mean, I've worked with several people about this, and they're shocked by my rules. And I say, listen, if you don't have the liquid assets to pay the taxes due, pay the taxes due, you're not a candidate to do this because there's going to be taxes due on this. Also, there's timing. Timing is important here. Got to be very careful to time your conversion at the best time of the year, so as not have to pay more taxes than you have to. The other thing I want to mention is that the conversion is a taxable event, and it will be included in your income. So if you're under Medicare Part B, it's going to add to your income. You got to consider that too. It's not just taxes, Dan. There are things, I call these things stealth taxes.
Sure.
As a result of this additional income. Please, ladies and gentlemen, don't do this on your own. Work with a qualified advisor.
Couldn't agree with you more on that, Ed. And I'll tell you, this is just another exceptional article. Thank you. And folks, can't say it any clearer than this. There's only one Ed. I don't know of anybody else that can go as deep and as wide on these things over so many different topics. So we're really lucky to have him. Ed, on behalf of all Feds everywhere, and of course, Serving Those Who Serve, I want to thank you for being such a great resource.
My pleasure. It's always a help. And just want to mention over the next few months, which is going to be the open season, we're putting out many columns on the open season, choosing the right health insurance plan, dental plan, vision plan, health savings accounts, flexible spending accounts, Medicare, choosing a Medicare Advantage plans. It's probably going to be at least 10 to 12 weeks of columns to help you make these decisions during the annual enrollment period if you're a retiree for Medicare, and if you're a federal employee for the federal employee, the benefits open seasons. We're here to help. A lot of material out there. Go to the website. We're trying to reach as many people as we can to take advantage of it.
Absolutely. Great tip. And folks, if you're watching this on YouTube, that's awesome. By all means, continue to do that. But don't be a stranger to our website, scwserve.com. So folks, that is a wrap. We are Serving Those Who Serve. Be sure to subscribe to this podcast. Hit that subscribe button on YouTube or Spotify. Share it with friends. Share it with strangers. Throw in a few enemies. Give them the olive branch. You might end up friends. And don't forget the live webinars that we do every single week. Head over to scwserve.com. Hover over that blue webinar button. It'll turn red. Very exciting. Click on it. Then you get the whole menu. There's tons to choose from in there. So the guru will come to you, reach you where you are, teach you where you are. And above all, we are here to serve you where you are. Sign up for one, sign up for all. Share it with your friends. They will thank you. And as Ed said, don't be a stranger from the Fed Zone. That's fed-zone.com. You can also find it at scwserve.com. He's writing every single week, and these are going to be coming rapid fire to help everybody during open season. So in closing, for my friend Ed, the crew at Serving Those Who Serve, and of course me, Dan Sipe, I'm going to close out as I always do by saying good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.